In this new segment of Advisor Revelations, the DPL team will discuss how to evaluate new solutions and address current challenges and the strategies that can help you grow your firm and AUM.
Hello and welcome to the Advisor Revelations podcast. I am Cam McCray, VP of Strategic Partnerships here at DPL Financial Partners, and your host for the day. Today, we are going to discuss recent and future innovations in the advisory annuity landscape. I'd also like to introduce our guest, who is VP of Business Development at DPL Financial Partners, Sam Johnson. Sam, thanks for taking time to join us today.
Absolutely, Cam. Happy to be here.
Great. Before we start today's discussion, I want to remind our listeners to please subscribe to this podcast on your favorite streaming app. For updates, if anything we talk about today interests you, please be sure to connect with a DPL consultant on our website at dplfp.com. All right, Sam, just so that our listeners have a little bit better understanding of yourself and your role, can you share a little bit about what you do here at DPL?
Yeah, Cam, VP of Business Development. So what does that mean? Work really mainly with our carrier partners. There's a lot that goes into them supporting not only the DPL business, but just RIAs and advisory products in general. You've got operations, marketing, technology, product design, et cetera. And that's for our existing carrier partners, but also the ones looking to get into the space. So kind of wear that consulting hat as well. And it's been a lot of fun. I would like to say welcome you to the business development team. Glad to have you aboard now that you're working the strategic partnership side.
Happy to be here. And yeah, with that background and kind of with your day-to-day at DPL, you are the perfect guest today. So what I'd like to start the discussion on, just so our listeners have a better understanding, is there's obviously been a lot of innovation over the past 6-7 years in the advisory annuity space. I'd like to hear from you what some of those biggest innovations have been so far, and just kind of give our listeners an idea of kind of where the industry was 6-7 years ago, where we're at today, and then we can kind of go from there.
Yeah, absolutely. No, love it. Past, present, and future. So the RIA community historically had never really used annuities, and otherwise just real sparingly so. It was kind of a 4-letter word for them. So as the insurance and annuity market has grown up, the RIA, kind of that our advisor demographic, really was never in consideration for the products, the processes, across the board. And it really wasn't the fact that their clients, they didn't value the benefits that an insurance company could offer, downside protection, guaranteed income, et cetera. It's that those products didn't fit their business model and mainly their compensation model. They're sometimes too expensive. They were paid by the carrier. They pride themselves on being a fiduciary. So it just didn't align. And so really, if you look at the last 6-7 years, you've seen a big shift of carriers offering advisory products and purely just stripping the commission out. You've started really with IOVAs, investment-only variable annuities. You had some successful ones with TIA and Jefferson National, now Nationwide's Monument Advisor. Those were kind of the two leaders in the space. And from there, a lot of carriers said, okay, that's what RIAs like and want. So we'll enter the marketplace with low-cost annuities as well to limited success.
And I know you mentioned stripping the commission out. Can you give our listeners an idea of what that exactly means? So when a carrier takes the commission out of a product, what is the benefit not only to the end client, but also to an advisory firm who, traditionally haven't been compensated via commissions?
Yeah, no, great question. The commission, again, regardless of if it's advisory or commissionable, you've got basically the compensation going to that advisor. And one is the fee from the client's account, paying that advisor for advice. But the other one, on the commissionable side, is the carrier paying a commission out for a actual product sale. Still can be in the client's best interest, still can provide a lot of value, but it is a payment from that carrier to that advisor or agent in that circumstance to make that sale. And what the carrier needs to do, since it's out of their pocket, is build in that expense for the commission itself. And then they also have to build in surrender schedules. There's a lot of components that the carrier is going to make sure that they are kept there's going to be a lot of areas where the carrier feels like they're putting their neck out there as far as the compensation goes to that agent of record. And a lot of times the client is the one that is penalized in case they want access to their money earlier or they find a better product. Surrender schedules exist for the carrier to recoup those payments. So with the commission-free products, all that goes away for the most part. And that's, significant consumer value.
Great. Thanks for sharing that and giving us a better understanding of that. So I didn't mean to cut you off, but it sounded like at the beginning with advisory annuities, basically the landscape was investment only variable annuities. So to me, that means variable annuities stripped out of living benefits, death benefits, obviously low cost, obviously surrender free, but really kind of missing some of the other features that make annuities attractive to clients. Of course, that being guaranteed income and principal protection. Can you talk a little bit about how that might have changed? It sounds like we might have more than just investment only variable annuities available today.
Yeah, absolutely. That's been such a fun part of the innovation, the evolution of the product landscape over the last few years. You've got really, like you said, it was a copycat, but it really was for the wrong reasons. It was just that it fit their business model. So as we were doing a lot of consulting at the time, it would be, all right, you carrier A, what is it that you do best? If you're leading in the commission side with principal protection, or like you said, guaranteed income, is it that you don't think end clients or an RIA's clients wouldn't appreciate those things? Or it's that a commission was the only reason why those products are selling? And the answer is just not the case. So you've got this change in the mindset of these firms that it's really supporting the advisor's business model and still having those insurance annuity product type benefits. And I think one of the biggest things that's helped tip that scale, DPL, we've done a lot, creating a marketplace for RIAs, showing that there's this demand. But you've also had this big shift of existing agents of record, existing commissionable advisors who are in agents working in wirehouses, working with broker dealers, even IMOs, here are starting to offer advisory versions of those same products because it now fits and better aligns with that advisor's and previous commission agents' business model. So that's driven a lot of innovation and change and really adding to the breadth and depth of all these different product categories, which has been great for our side of it.
Great. So in short, these days, we've expanded the marketplace to where now if there's a commission version of an annuity, it's basically available in the advisory business model. Is that accurate to say, Sam?
Yes, across the board.
Perfect. How would you say, and I have my own thoughts because I see the data, but the introduction of fixed index annuities and RILAs or registered index linked annuities, when compared to their investment only variable annuity brethren, which used to dominate the sales landscape and took all the assets, how would you say the solutions that traditionally provide guaranteed income, principal protection, like the FIA, like the RILA, how have they done? And I mean, how have they done from an assets inflow standpoint? Has it gone well for them? Are advisors utilizing them? Do clients like them, et cetera?
Yeah. The IOVA definitely still has a fit and gained traction because it was that low cost alternative annuity rescue landing spot. But as these advisors, sometimes that were previous annuity users or new annuity user that's been educated, that's a big part of what we do here at DPL on the benefits of RILAs and fixed index annuities. But when you strip out that commission, oftentimes you lose any surrender schedule. You've got very competitive caps, guaranteed rates, everything that you're looking for from those two product categories. But then you go through, all right, these are not being sold but are being bought. And they're being bought because it fits an aspect of the client's portfolio. So when you're able to educate the advisor on the benefits of principal protection or how to manage volatility and risk within a portfolio, or their fixed income returns aren't exactly where they want them to be, and they're looking to even turn on income from some of those categories, the actuarial or the academic research is just insurmountable at this point. And it's really something that the advisors can't replicate on their own, especially at the scale that these carriers are able to. So not for majority and not for a large portion of a client's portfolio, but I think a lot of the RAs we work with and either users or non-users in the past really see a fit for those other categories. So we've seen a huge increase to RILAs and FIAs specifically over the last few years.
Great. I echo that. I think when I think about the pie chart that I see of kind of flows and where things go, they have definitely been higher than even I would have probably expected an RIA to gravitate towards. But at this point, they take a big portion of the pie. So thanks for sharing that. Switching gears a little bit, I think that was a great quick history lesson to kind of give our audience to show them where we're at today. I'd kind of like to shift the conversation into kind of like current state. So what are we seeing now, whether it's from the carriers or maybe from DPL, that are kind of still innovative ideas to make things easier for RIAs to have access to these types of solutions, to utilize these solutions in their practices?
Yeah, a great question. Very timely with what we're seeing and what the firms we work with are asking about. And so I've kind of thought about this, and I think there's advisory fee friendly products, and now we're working towards advisory process friendly products. And that really gets to, as I previously mentioned, the RIA was never in the ecosystem or in the life cycle of the annuity process, from proposal to doing an application to post-issue support, data feeds throughout the whole thing. So as you've got this individual, this RIA, this advisor of record being interjected and one of the most important parts into that entire, again, lifestyle and ecosystem of the annuity experience, a lot of these processes need to change to accommodate them. So that's really what we focus on here at DPL, and kind of boil it down into three areas. You've got discovery, fulfillment, and management. And where our big focus, historically has been on the discovery side, and why people should be open-minded to not only the investment-only VAs like we were talking about, but where RILAs make sense, where fixed index annuities make sense, what it can mean to, from a retirement income standpoint, et cetera. And then once you cross that threshold, that barrier, and get them to say, okay, this makes sense, because they're not compensated any more than if it's in their bond portfolio or within that fixed index annuity, and you get them to make that acknowledgement, okay, now you're telling me this makes sense for a portion of my client's portfolio, and not just one client, but likely across majority or a portion of their book of business, which can be oftentimes hundreds, if not thousands of clients. So now what we're trying to solve for is, how do you fulfill? How do you do, efficient and scalable adoption for these firms that you've worked so hard to understand the benefits and adopt the idea of using annuities? And so that's really where the current focus that we here at DPL, and then I think a lot of the insurance carriers that we work with, realize they've got some legwork to do on their side to improve that process.
Great. So what I'm hearing, Sam, is essentially carriers and DPL have done a great job of bringing RIA-friendly solutions to the platform. They create a great value to the end client, whatever that client's goal might be. It's easy for a firm to utilize some discovery tools via the dashboard. But here recently, the focus has shifted to more processes and making it easier, create less friction for firms doing this en masse. So you mentioned the word scalable. Can you talk a little bit about the fulfillment process, kind of current state, and kind of what it looks like, and why that might be different than it would have been 2 years ago for a firm looking to get a client into an end solution?
Yeah, absolutely. So when we first started at DPL, we just wanted products and carriers on the shelf. So we were accommodating to all the different practices, rules, operational, paperwork requirements, et cetera, that each of those carriers had in place. And the reason why RIAs are who they are, and why that business model attracts so much from the advisor and the financial industry, why flows are going there, is because they're open architecture, where they're not beholden to one particular, in this circumstance, one carrier, one product type. And so what we need to be able to do at DPL, and what we've been focusing on, is how do you normalize and standardize that application process across, I think we've got about 20 carriers on the platform, 60 plus, products, so when that DPL employee is helping to fill an application, when we're helping to enable and empower advisors and firms to fill out their own applications, how do you make that, again, as standardized and formalized as process or as possible? And so that's a big area of what we've focused on. And like you said, recently I started going live with digital applications, working with many of our strategic partners to start pre-filling a lot of those resident advisor client information, and really trying to streamline as much of that experience as possible from a digital experience standpoint.
Great. So you're telling me digital applications. That means no longer are we having to worry about 40 to 80 page applications going out to an advisor to fill out.
Exactly. What signatures, hopefully never physical copies, hopefully outside of rare circumstances if they're needed. Let's all collectively work to get annuities and insurance into the 21st century from a paperwork standpoint.
Great. So the digitization of the process is basically where we're at today. And so I guess that's kind of the theme is, hey, first step, get the products created. Second step, get the process right. And by process right, I mean meeting the RIA firms with their processes and how they traditionally transact their business.
Yep.
Thank you for sharing that. The next topic or kind of conversation I want to discuss, Sam, is I think our audience has a pretty good understanding of where it was, where it's at today, particularly focused on processes and ease of doing business. And you mentioned some of our strategic partners for our audience. That means, think the tech softwares that you might utilize, partnering with them to be at your fingertips. That is in motion as well, trying to meet advisors where they do business and live. I'd like to just hear your thoughts, Sam, and this is pretty open architecture question, but what is next? So what do you see next from the industry, maybe down to carrier level, maybe down to product level, maybe to a DPL level, but what do you see kind of what's next from an innovation standpoint to, keep pushing the ball down the field, so to speak, from an innovation standpoint?
Yeah. Wow. That was pretty open-ended. You can take that in a number of ways.
We can take it in pieces.
Okay, perfect. So let's start with tech. I think one area that we're really focused on that's great that DPL focuses on that discovery, fulfillment, management side. And we've, I think, got a great tech platform for doing so. But meeting, again, as we want the carriers to do, by extension, that's something we want to do as well. So taking those three main tenets of an experience and then integrating that experience as much as possible into those desktop wealth management platforms. Again, at discovery, tool standpoint, fulfillment, leveraging information we can pre-fill, and then making post-issue management, seamless as well. So that's one big focus. Again, trying to meet that advisor where they are. You've got just a general digitization of the overall experience. And this starts to become more of an industry-wide situation. I know that, as previously mentioned, there's a lot of commissioned agents who are now using advisory products, and we're needing to improve those circumstances or situations. But there's not QSIPs for annuity products. So the Insured Retirement Institute, IRI, has a big digital-first process and is really trying to digitize a lot of aspects of it, visibility, e-signature. I'm trying to just improve that overall annuity experience. So I think those are two really big things from a industry standpoint. And then I think kind of taking it a little more closer to home, back to kind of that carrier product innovation. And this has been a little bit surprising on my side. Been so oriented and focused on that discovery side, so oriented now on fulfillment, is that post-issue management, I think, is where the next biggest innovation is going to be.
Thanks for sharing, Sam. So regarding this carrier product specific innovation, can you give the audience some more details of what you mean by that?
Yeah. Again, this has been really eye-opening, and I think it is easy to connect the dots. But I know LIMRA recently came out with their data, and I think unsurprisingly, the commission annuity world, majority, I think to the tune of 85% or so, I wouldn't be shocked if even it was a little bit higher, are 1035 exchanges. And that's historically been kind of why their industry can have a bad reputation at times, is the policies get out of surrender schedule. And then those are the first ones that go, or policies that go to the top of the list for a new 1035 opportunity to go into a new product and a new surrender schedule. So they're sold, hey, let's use this for retirement income. You've got this benefit base, and then 7-10 years down the road, look at this new product. Still solve that retirement income. Here's this better product. Just restart the surrender schedule. May have a deferral period, benefit, bonuses, all that stuff. But I don't think those products are really being used as they were originally intended.
Yeah, real quick, just so to repeat what you said so I understand. So basically what the data is saying is, 80% of sales are via 1035 exchanges. And just to break that down for our audience, what Sam's saying is the data is saying 80% of what's happening are clients who own existing annuities are being sold another annuity, which tends to happen after the surrender schedule's over. that product would now be liquid, but someone's deciding that's no longer a fit for the client and they're being sold a new solution. Correct, Sam?
With a new commission and a new surrender schedule, et cetera.
Okay.
Now, there's probably plenty of times that's on the up and up, but yes, that's the majority of sales in the commissionable space.
Okay, great. So now that we have that baseline, it could be debatable whether it's a good thing or bad thing, but where do you see it moving forward, particularly with the audience shifting from commissioned agents to fiduciaries, RIA firms, advisors of RIA firms, et cetera?
Yeah, exactly. And because back to that original comment, that this is compensation coming from the client to the advisor for advice. And it doesn't matter if it's in an annuity or in mutual funds, however the advisor is managing those assets, they're charging the same fee, that they are not incentivized to move the assets unless there's a reason to. So I think that the products that clients go into are going to be used for their benefit at a much, much higher rate than their commission counterparts. So when you've got a client that bought a product for income, that when a carrier may now think of post-issue support as a change of beneficiary or paying out and figuring out a death benefit circumstance, that post-issue support is going to be actually helping that client turn on the income, helping them do so quickly, efficiently, and send it where it needs to go in a much more timely, efficient manner. So that's where I think that next kind of evolution is for products and on the innovation side and really on the carrier side from an admin, operation, and technical standpoint to support these products actually being used for their intended goal and solution that the client's anticipating.
That tracks. I think that makes a lot of sense. I think that's what I would expect to see. You're shifting the traditional users of annuities who are compensated via commission to an audience who is fiduciary, who is compensated an advisory fee for advice regardless of what they're utilizing for their client. Logic would tell you that clients will be holding solutions for longer and for the intended purposes of whatever that client goal was. I believe you said earlier, the shift from solutions being bought, not sold is kind of what we're seeing. I think would be a great way to sum it up. Well, I think I will wrap it up there, Sam. I want to thank you for joining us and being a great guest for this episode. I'd love to give you kind of a chance to say anything in closing, if there's anything that we left out or anything that was top of mind here before I wrap up.
I think the only thing is just it's been so positive the last few years, and especially again seeing LIMRA reports and the growth that advisory annuities are having right now, be it through distribution channels like DPL, directly from carriers, through wirehouses, broker dealers, et cetera. Just the growth of advisory annuities, I think, is changing the conversation, the landscape that is going to make my day-to-day easier, and just in general, like seeing that for the benefit of the industry and the end consumer. So that's been a lot of fun, and can look forward to that continued innovation that we discussed to move along.
Well said, and I agree wholeheartedly. I think very positive, moving full steam ahead as an industry. So again, Sam, thank you for joining us.
Yep, thank you, Cam. Great host as always.
And thanks to the audience. Thanks for being on with us today. And again, if you're interested in learning more about DPL or anything that was discussed today, let's connect at dplfp.com and subscribe for more episodes like this anywhere you listen to podcasts. Have a great day.
Thanks for listening. To hear more advisor revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.